Next, let's look at some of the challenges that they are facing. So there are many here, and I encourage you to read the whole thing for yourself. But I would highlight the ones that I think are most important. So the first most important one would be the ability for Alibaba Group to replicate and adapt their procedures, such as technology and logistics, outside of China. So I think this is not so straightforward, and it's a challenge that they will be facing. Secondly, geopolitics. So I think that this is quite well described. So protectionist or national security policies can restrict their ability to invest or acquire companies overseas, develop, import or export certain technologies, or utilize technologies that are deemed to pose a threat to national security. Thirdly, the privacy laws and data security laws, including GDPR and other compliance costs, can be very high. So depending on their ability to comply with different regulators, this can affect their ability to grow in international markets. Alright, so now let's put together the numbers that we found and try to give an estimate on the fair value of the stock based on certain assumptions. So as of this recording, Alibaba is priced at around $315 billion. The free cash flow for their fiscal 2021 is $26.353 billion. And let's say I want to beat the market significantly. Instead of 10%, I want 15% on my money. I also have to consider that any shares that I buy can get diluted. And historically, Alibaba has diluted shareholders around 2 to 3%. So I'm going to assume that my desired yield should be 18%. So let's call this yield 18%. So this is our target. Now, let's take the worst case scenario, or a very pessimistic scenario, where instead of growing at 27% CAGR in the past, moving forward, let's say Alibaba Group grows at only 15%. So let's calculate the free cash flow on that in 5 years. So we take the current free cash flow and multiply that by the growth rate, which is 15%, an increase of 15% over 5 years. This gives us a future free cash flow of 53 billion. Now we can calculate the price. So in this scenario, the price would be free cash flow over our expected yield. So if you recall, the reason why we're calculating this way is because the inverse of price to free cash flow ratio is actually the yield. So we can take their future free cash flow of 53 billion and divide it by our expectations, which is 18%. And this gives us a current price of $294 billion, which is not very far from the current price. So I would say that this is close to fair. So the current price is fair or slightly expensive, if these are your assumptions. For the second scenario, let's say that Alibaba grows around 20% instead of the 27% historically. The free cash flow on that would be then 26.353 multiplied by 1.2 over 5 years. And that gives us a future free cash flow of 65.57 billion. So to calculate the price we should be willing to pay for such a company would be to take that number and divide it by our expectations, same as in scenario A, which is 65.57 over 0.18, and that gives us 364 billion. So relative to their current valuation, which is 315, it is around 15% undervalued. So I think this is the most likely scenario, and this is the number that I'm pricing it at. So at current levels, the stock is actually slightly undervalued, and it will be suitable for me to continue dollar cost averaging in. It is also possible that they beat this growth because of two things: cloud computing and their international expansion. Of course, the risks are still there, so make sure you do your own due diligence before making any decisions.